This disaster of a portfolio was constructed using one of the worst financial ratios in the history of mankind. And if you're a dividend investor, you're probably using it right now.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
You're probably wondering, how did I manage to create such a disastrous portfolio? I downloaded a list of the S&P 500 stocks, and then I ranked them by dividend yield. This single metric is responsible for more financial pain than quite possibly any other. Dividend yield is a very enticing metric, and a lot of investors, especially beginners, will fall into its trap. In this video, I'm going to show you 5 simple ways to fix that. So we're going to start with a portfolio of the highest 30 dividend yielding stocks in the S&P 500. And then I'm going to show you how to make it a lot better. How much better to be exact? 272% better. And that's definitely not a made-up statistic. That is very scientific. So here is the initial portfolio. This is every stock in the S&P 500 sorted by dividend yield, top to bottom. And then I simply took the top 30. This list has a dividend yield on average of 5.25%, which sounds pretty appealing, especially when the 10-year US Treasury is yielding 1.3%. As enticing as this list of stocks may look at the surface, this is not a good portfolio. Fortunately, we're going to fix it, and we're going to start with payout ratio. Payout ratio is simply the dividends a company is paying out divided by the earnings the company is bringing in. So if a business makes earnings of, say, $1 million, and they pay out $500,000 per year to their owners, this company has a dividend payout ratio of 50%. If the same company earning the same $1 million would decide to pay out, say, $2 million, the payout ratio would then be 200%. Now, obviously, this company cannot pay out $2 million for long. So if we look at this entire list of stocks, we can calculate the average payout ratio, excluding the negative numbers, which I'll get to in a second, has a payout ratio of 80%. We want to go for closer to 50%. 80 is definitely too high. So to fix this, we're going to go through and get rid of all the stocks that have a payout ratio of 100% or more. If we eliminate all of those stocks and then re-rank everything by top dividend yield, we would then have this portfolio. Now there's one other thing you might notice, and that is there are some negative numbers. A negative payout ratio means that the company is losing money. Obviously, a company that is losing money cannot continue to pay a dividend for very long. Step number 2 is to delete all companies that have a negative earnings per share over the last 12 months. So we're going to go ahead and get rid of all the negative numbers in this column. So we're going to go ahead and delete those and then again re-rank by dividend yield. After taking these 2 steps, our payout ratio has now dropped from 80% in the original portfolio down to 59%. The downside is that our dividend yield has also dropped from 5.25% down to 4.75%. However, this 4.75 is now much more sustainable. In step number 3, we're going to focus our attention on dividend growth. We don't just care about current dividend income. We want dividend income that is growing consistently over a long period of time. Ideally, we want our long-term dividend growth to be at least keeping up with inflation. That way, our real income is going to grow over time and not just remain stagnant or decrease as inflation eats away the value of dollars. So we're going to take our list and look at the last 5-year annual dividend growth. And I'm going to eliminate any stocks that have not increased their dividend by at least 3% per year. So for example, GE was on this list somewhere. Their dividend growth is negative since they cut it. So they would be eliminated from the list. We're also going to delete any of these stocks in red. And again, we will re-rank based on high dividend yield. Now we've got companies that have raised their dividends by at least 3% over the last 5 years. But there's one other growth component that is important to consider, and that is sales growth. In step number 4, we're going to eliminate any company that has sales growth of 3% per year or less over the last 5 years. Sales are the lifeblood of any company. A business that has stagnant sales is eventually going to have stagnant earnings. There's only so much cost cutting and margin improvement you can really get before you really have to have sales growth to get earnings growth. And if earnings are not growing, you're not going to be able to increase your dividend. So let's look at our portfolio and let's eliminate any stocks that we're seeing sales growth below 3, and that kicks out over half of the list. And once again, we're going to eliminate all of these stocks and re-rank them by highest dividend yield first. There's still one more ratio that we need to look at in order to really make this list as good as we can get it. Eliminating companies that have low returns on invested capital. Warren Buffett and other highly successful investors almost universally focused on companies that have an enduring competitive advantage over their peers. A business that has no competitive advantage basically is only competing on price. The average company on this list had a 5-year return on capital of 14%. So what we're going to do is eliminate all of the companies that have returns on capital of 14% or less. We will delete these stocks and then again, re-rank them highest dividend yield at the top. Now let's take a look at how much our portfolio improved. Our payout ratio of the new 30 stock portfolio, which I'll show you in a second, declined from 80% in the original portfolio to 45%. So we're almost twice as sustainable on today's dividend. The 5-year historical dividend growth rate increased from 9.7 to 11.8. The sales growth went up more than 8 times to 8.1%. The 5-year return on capital went up nearly 3 times. And then the estimated dividend growth rate, which is simply the minimum of 5-year sales growth or minimum of 5-year return on capital multiplied by how much money the business is reinvesting, went from a negative number to now almost 7% per year. The downside is that our dividend yield did decline from 5.25 down to 2.37%. However, this is a much more sustainable situation and one that is likely to grow well into the future. Here are the 30 companies. This is not a recommendation to buy this portfolio or even buy anything on this list. Do your own research, look more into these names if you're interested. And if you want to dive into the most important metric on this list, check out this next video where I'll explain why I think this is Warren Buffett's absolute favorite metric to look at and why 95% of investors completely ignore it.